Hi and welcome to the Market Alert for Friday, the 13th of August 2021. So Friday the 13th, the day for those that are superstitious amongst you. But yesterday the PPI panic sparks, big tech bid, small cap skid and cryptos crumble apparently. And hotter than expected PPI print spoiled yesterday's transitory narrative confirming CPI print, which means basically that the inflation isn't transitory and is likely to move higher. And another headline here, plunging crop supply send prices soaring and reignite food inflation fears. WASDE reports. This report means that adverse weather conditions are another driver of food inflation that shows no sign of stopping. Just cast your mind back the last 10 years in the Market Alert where I've spoken about this. It's blatant when you weekly shop, monthly shop, whatever you do, about the food price increases. They are significant to say the least, and also smaller amounts to boot. Gold flash crash from last weekend, Sunday night. Brilliant interview here. Well worth a watch. Egon van Gones, I think his name is. May have that wrong, but always worth a listen. I'll put the link in the description below the YouTube video, but he explains why it was manipulation, and it's very simple as well, but I won't spoil it. I'll let him tell you, but well worth a watch. Here's another interesting metal story as well. Another industrial metal hits record high prices. Aluminium's rally has been driven by a rebound. Now, silver is an industrial metal as along with a monetary metal, and it's the monetary aspect of it is the issue of manipulating it to the downside, because the founding fathers of the US obviously stipulated and mandated that silver would be a monetary metal and form the part of the financial system, whereas aluminium of course isn't, or copper. So they're allowed to run free, the price is allowed to make all-time highs, but silver not, because of the monetary aspect of it, because any increase in the silver price and gold price shows a failure of the current fiat system. So that's why, another reason why it's being suppressed. But of course, once the lid is allowed off, then you'll be seeing these sorts of headlines as well. Gold and silver hit historic highs, etc. But we've got to wait until the bankers are finished manipulating that in order to enjoy it. Implied volatility also moving to the downside, because we've had another all-time high yesterday in the indices, 1329 down to 1275 for the Dow. Now this is interesting because that 1275 is one of the lowest that we've had for a while, and like I've said before, pre-COVID crisis, which you can see here. The implied volatility's range in the lows, when it forecast and predicted a correction, was down at the 10% level. So it'll be interesting to see if we can get a new low over here in this range, 1275. I think we've been slightly lower, but you can see that support there. If we can break that to the downside, that would be fantastic. And if we can keep the market going up through September, and then the usual October flash crash and everything else could possibly be on the table as well. Also, something that I haven't got a news graphic for is this weekend, of course, we see, and they're going to actually celebrate the 50th year of coming off the gold standard on Sunday, when Nixon announced that he would remove any form of precious metal backing to the US dollar and let it run wild, which it certainly has done, and now 30 trillion later after 50 years. Plus another 4 trillion coming down the line to add to the balance sheet as well. Meanwhile, news for today, we've got prelim consumer sentiment. This is out at 3 p.m. There is no other news, so the market's going to have to make its own direction. And finally, the gold-silver ratio, whilst we're talking about news, continues to move to the upside, making silver cheaper as far as against the price of gold as well. And I've said to you before, last year, I took advantage of this when we hit these 125 levels and bought more physical. It was a no-brainer. You get 125 ounces of silver to 1 ounce of gold. So bring it on. Like I keep saying, you make it cheap. If you want to make it a bargain, I'm more than happy to go along with that. No problem at all. I'm in for the long haul with this, and eventually the system will fail. There's no doubts about it. One other thing, actually, I'm just going to pause and bring this up for you. Okay, so I've managed to find the articles, and there's a couple that sort of ring in alarm bells. The first I actually covered in the Market Alert, which was this one. The IMF creates record 650 billion slush fund for pandemic relief, which is slightly odd given the fact that there were trillions actually printed last year by all central banks of the respective countries, including the UK as well. This was out on Monday, August the 2nd, but a lot's been said about this of late by Lynette Zhang, Gerald Celente, and many other commentators as well. And the IMF, I think that it says in here that the International Monetary Fund has approved a record 650 billion in special drawing rights, which is a basket of currencies to help nations dealing with mounting debt and the fallout from COVID pandemic. According to Bloomberg, which notes that this is the largest resource, that's the bit, the largest resource injection in the organisation's history. Well, hang on a minute. If there's no problems and everything's getting back to normal and the financial system is sound, then why are they doing this? So it got me thinking, and I thought, well, many years ago, after the financial crisis, the UK actually instigated the Bail-in Act 2011 and 2013 for building societies. And out of the blue, this has appeared, executing bail-in, an operational guide from the Bank of England. So the Bank of England now have actually issued all of the necessary paperwork and guidance on bail-ins. Now, they wouldn't be doing this or putting the legislation in place as they did in 2011 and 2013 if there wasn't a reason to do so. So again, as we head towards the autumn, things are starting to look a bit sticky, to say the least. The IMF are actually issuing 650 billion in special drawing rights to create liquidity for central banks, and this also about the bail-ins by the banks. Of course, they have got the guarantee scheme. Anything over 85,000, anything over that will be taken, and in exchange you will receive worthless bank shares. So that's how it works. But they've gone to a lot of trouble to explain how they're going to do this, should they need to do it, which is, I thought, was very timely, to say the least. So I just thought I'd bring this to your attention as well. I don't want to dwell on the fundamentals too much, but I just wanted to share this because there are things going on in the background, like I say, that you may miss, which especially things like this. I mean, God, there's nothing more dreary than reading these sorts of documents, but I just thought, well, this is interesting because they've not said anything about this for years. Now all of a sudden we have all of these booklets that have been issued by the Bank of England, and also templates and how the transfers work, and etc., etc. So let's wait and see. Anyway, let's move on to the markets. We'll start off with the Dow. I'll just find the daily chart, and you can see that yesterday we had another all-time high. And again, this is the smoke and mirrors, isn't it, of all of this, that they're continuing to pump the markets to the all-time highs. You can see that the Dow has closed above the 5-bar moving average for 6 days now, and continues to move to the upside as well. New all-time high for the market yesterday. Not a lot else that I can say, apart from at some point, obviously, it's going to correct if they allow it, and when they allow it to do so. We could draw in a couple of fibs just for any sort of retracement, because there will be profit-taking moves along the way, and these are the fib areas that I would expect to see some sort of pullback. But first, obviously, a close below the 5-bar moving average, which measures the momentum of these markets. The 30-minute chart for yesterday, we sold off at the open, and classic, and we brought it back a bit like silver, actually. It's the same pattern at the moment. And again, I would suspect that these sell-offs at the open, because you've got the pajama traders moving the market to the upside, and then, of course, this allows the elite and those in the know to offload their cash positions, which then forces the market lower. But they do a good job first to bring the premiums up on the shares beforehand using the futures contracts. In the DAX, we have the same situation here. We've closed above the 5-bar moving average here. We've got 1, 2, 3, 4, 5, 6, 7, 8 days now of the market closing above the 5-bar moving average, also putting in a new all-time high, and the new all-time high is 15,975, 16,000 on the cards for the German DAX. Again, the same as the Dow, these would be the areas of support if there is a correction or it's allowed to correct. And to be honest with you, the 38% retracement again ties you in with that 5-bar moving average where the market would likely find some sort of support. And if we look at the 30-minute chart, that would also tie you in at this sort of area where we have yesterday's low, which is 125 points thereabouts down to this area. In between this, though, we've got the DP and the S1 also. Yesterday's action, you can see that we sold off, we moved lower initially, and then at 7 a.m. we got the GDP figures from the UK, which we'll look at in just a moment. And prices then was just a one-way bet in the 30-minute chart. Prices continuing to close above the 5-bar moving average until we got to the end of the session for the day. So prices moving all the way to the upside, and overnight we've got the market just sitting at the BRN in the 2-minute chart, and the 200 MA still posing a bit of resistance there at the moment. Probably see a bit of pullback initially, and then market moving to the upside. But it could be quiet, given that we've had 2 days to the upside, 2 new record highs, and the market may need to take a breather, unless of course there's no selling, and then they're free to move the market and continue to do so to the upside. In the metals market, starting off with silver, we can see that this is still sideways to lower, still making lower highs each day at the moment. This is not convincing by any means. No close above the 5-bar moving average either. So once again, I'm still looking at this market moving to the downside. They're going to do whatever they can to move this to the downside, and these are the downside fibs for this market. 22 is the area. I still have an ordering down at the $20 area, just in case they want to give a celebratory smash to the price on Sunday night when the market's open, in observation of the 50-year anniversary of the Nixon removal of the gold standard. Just being cynical, but the order is genuinely in there. But that's you just never know with these banksters. You just never know. Gold, on the other hand, is moving to the upside a bit, which is why I've shown you in the gold-silver ratio why you're seeing silver or the spread widen, which means that if you're going to be invested in the physical metals, you'd want to buy anything over 50 ratio. You'd want to buy the silver because it gives a better bang for your buck over the gold ratio. The gold returns. You get a far better return on 1,000 coins as in silver, as whatever 1 ounce divides by. Sorry, it's not going to be 1,000 coins. It'll be 50, 60 coins. And you can sell all of those with a greater return. That's the idea of looking at the gold and silver ratio. I'll do a video on that at some other point in more detail and a bit more eloquently as well, with a bit of a clearer understanding. But this is not the place for it. We can see there that the dollar's trying to move to the upside, still stuck at that 93.15 level. Will it break it? Don't know, but if it does, then we continue to move higher for the dollar as well. So a quick look at yesterday, an interesting, strange day, but we kicked off in the morning with, I'll just find this, I'm just looking for the news, there we go, I can see it now. So yesterday we moved higher from the off. There we go. So we moved lower from the start of the trade, with the futures market moving lower. I spoke about the GDP figures. They caught my attention because of those ridiculous projections of 4.2. Just to bring this all up to date in a second. There we go. Sorry, it's 4.8, which you can see there. And then surprise, surprise, the news comes out, and guess what it is? It's bang on the 4.8 as predicted. So you can't make this crap up, can you, anymore? It's just unbelievable. So that was enough to send the market up initially, but then it weakened and came all the way back down to the DP. You see them buy back in at the DP here, increase in volume, and then as soon as we open on the cash market, we trade to the upside, and then the market goes incredibly quiet. And again, this is forewarned. You could see the same thing this morning, because the market needs something to move to the upside. And if you can't move up on that sort of situation there, where you're getting a 4.8 percent coming out, you've got brilliant news there. It comes out exactly as predicted, and then the market trades sideways. So if we've got no news this morning, then who knows? It could be desperately quiet. But anyway, the market trades up, and it makes a new all-time high mid-morning, and this is a pattern that I've seen, and I'm working on it at the moment, that we're starting to see the situation where the market's changing, and that is, it's quiet during the first couple of hours, and then when everybody sort of abandons ship, it's then doing what the pajama traders have been doing in the Dow, moving the market to the upside when no one is looking, sort of mid-morning time. So here you see the market put in the new all-time high, then it comes back and stops bang on 89%, and then trades sideways, waiting for the next news, which I'll just bring up in a second. Just seen it go by. There we go. We had the initial jobless claims stagnate for 12 weeks. A straight week. Over 12 million Americans remain on the dole, so over 10 million job openings and over 12 million people on the dole. What's wrong with this picture? Well, apart from the fact that the numbers are rigged, we can see that there is an issue. Nobody appears to not want to work following the stimmy checks. But anyway, that didn't make any difference, because they used that news. It was good news to break above the all-time high from the previous day and continue this on through, and then the market opened. The Dow sold off, as we saw in the 30-minute chart, and the DAX coming under immense pressure. I can see from this new all-time high to here projected back is 78.89 as well. So as the market got through and then closed back through the 5-bar moving average, the Dow went south, and the DAX then eventually followed. So it was the Dow that brought the DAX down. Had the Dow continued to move up initially, we would have followed up. But as we saw in the Dow in the 30-minute chart, came under immense selling pressure from the start, having made the new all-time high, which again is not uncommon. Which, like I've said, we've just marked up the daily charts for the Dow and for the DAX. For that very reason, that you could see a bit of a pullback there. Okay, I've gone on long enough. It's a lot longer than usual, so apologies there, but a lot to cover today, and we'll see what happens over the Nixon weekend, as I'm going to call it. So, yeah, have a good one. As ever, thanks for watching. See you in there.